We all know that credit card companies make money by charging interest. But buy now, pay later companies don't offer any interest on their loans. So how exactly do they make money? Let's start by going over what buy now, pay later is. Buy now, pay later is a type of loan that allows you to finance your purchase of goods or services in installments over a period of time. The biggest difference between buy now, pay later and credit cards is that with buy now, pay later, the merchant or store you are buying from is the one who gives you the loan instead of a bank. Also, buy now, pay later loans are typically only available for purchases above a certain minimum amount. And unlike a credit card, you are not given a lump sum of money when you sign up for a buy now, pay later account. Instead, the money is given to the merchant whenever you make a purchase. The merchant then uses that money to fulfill your order and gives you the item. This means that you will not see a deposit or a charge on your bank account when you use buy now, pay later. So how does buy now, pay later work? Let's say you are shopping at an online store and you find a pair of shoes that you like, but they cost more than you expected. You can use the buy now, pay later option to pay for them over time instead of paying the full amount up front. When you select the buy now, pay later option at checkout, you will be directed to a website where you can create an account and set up your payment plan. You will need to provide some personal information such as your name, address, and social security number, as well as information about your employment and income. Once you have set up your account, you will be able to make your first payment towards your purchase. The remaining balance will be divided into equal payments and debited from your bank account automatically on a set schedule. In this way, you will be able to pay for your shoes over the course of several months without having to pay the full amount up front. Sounds great, right? Well, it might not be as good as it sounds. In fact, according to CNBC, 41% of users end up missing at least one payment. So why would anyone ever miss a payment on something that is supposed to be affordable? That brings us to our next question. What is the secret behind the success of buy now, pay later? The success of buy now, pay later lies in its ability to trick consumers into thinking that they have more money than they actually do. By spreading out the cost of a purchase over several months, buy now, pay later makes it easier for people to justify making a purchase even if they cannot afford it. It also encourages people to buy more expensive items than they would normally be able to afford because the monthly payments are so low. For example, if you were considering buying a new TV but couldn't justify the cost, you might be tempted to use buy now, pay later to finance the purchase. With buy now, pay later, you can stretch those payments out over 12 months or more, which makes it easier to justify. You may not notice that you re-spending more money overall because you only focusing on the monthly payment, and that monthly payment could be less than the price of a streaming service, which makes it seem like a no-brainer. But over the course of 12 months, you end up paying much more for the TV than you would have if you had simply paid the full price up front. This is because buy now, pay later companies typically charge late fees and interest on missed or late payments, which can add up quickly. In addition, by spreading out the cost of a purchase over time, buy now, pay later also makes it more likely that people will make impulse purchases. Impulse purchases are purchases that are made without planning or consideration. They're often driven by emotions like excitement or desire and can result in buyer's remorse. One study found that 51% of Americans said they had made at least one impulse purchase in the past month, and 14% admitted to making one every week. Impulse purchases are a huge part of the retail industry, and it is no surprise that buy now, pay later companies want to encourage them. After all, the more impulse purchases that are made, the more money the company will make. But buy now, pay later companies are not the only ones making money from impulse purchases. Merchants also benefit from them. When you use buy now, pay later to make a purchase, the merchant receives the full amount of money from the company. This means that the merchant does not have to wait until you pay off your loan in order to receive payment. They also do not have to worry about bad debt, since the company will not charge them back if you fail to make your payments. As a result, merchants are incentivized to promote buy now, pay later as a form of payment, and many of them offer discounts or other incentives for using it. But what happens when people cannot keep up with their payments? Buy now, pay later companies make money from late fees and interest on missed or late payments. On average, consumers with active buy now, pay later accounts have 5 different loans outstanding and are paying $19 a month in interest and late fees. Late fees can be a percentage of the payment or a flat fee. For example, a flat fee of $10 may be charged if a payment is more than 7 days late, or a percentage of the total loan amount may be charged as a late fee if a payment is more than 30 days late. Interest rates vary depending on the company, but they can be as high as 30% APR. One thing to keep in mind is that buy now, pay later companies often report your payment history to credit bureaus, which means that if you miss payments, it will damage your credit score. Credit scores are used by lenders to assess the risk of lending money to you. If you have a low credit score, lenders may think that you are more likely to default on your loans, which means that they may charge you higher interest rates or may not lend to you at all. If you have never taken out a loan before or have a thin credit file, you may not have a credit score. In that case, buy now, pay later companies will typically use an alternative method to assess your credit worthiness. This may include checking your bank account or looking at your social media activity to get an idea of your spending habits. They may also use predictive modeling to assess your credit worthiness. Predictive modeling is a method of assessing the risk of lending money to someone by using data and algorithms to predict the likelihood that someone will repay their loan. Predictive modeling takes into account a variety of factors such as your age, income, location, and credit history. Although buy now, pay later is still relatively new, it has already caused concern among regulators who are worried about the potential risks it poses to consumers. One of the main concerns is that buy now, pay later companies are not required to report positive payment history to the credit bureaus, which means that even though you may be making your payments on time, it won't help improve your credit score. Additionally, as we mentioned earlier, buy now, pay later companies often report negative information, such as late payments, to the credit bureaus, which means that if you miss just one payment, it could damage your credit score. Another concern is that buy now, pay later companies are able to lend money to people without requiring them to have a traditional credit history, which means that they may not be able to assess the risk of lending money to these people accurately. This could lead to a situation where a large number of people default on their loans, which could have negative consequences for the economy. In the future, buy now, pay later companies may be required to obtain a license from the Treasury Department as Financial Crimes Enforcement Network, which will require them to comply with anti-money laundering and terrorist financing laws. Additionally, they may be subject to greater scrutiny from regulators in the future. Only time will tell how all of this will affect the buy now, pay later industry. If you found this video helpful, please remember to subscribe and leave a comment below if you have any questions. We'll see you in the next video.